This is your host, Stephen Sargeant, the Around the Coin podcast. This episode is everything you need to know about real world asset tokenization. We bring on Angus O'Callaghan, head of markets at XDC Network. It's a layer one blockchain starting around the same time as Ethereum that's building out a hybrid approach of both public and permission blockchain services to some of the biggest real-world asset tokenization companies around the world. And their partnership with Keith O'Callaghan, no relation, who's the head of asset management and structuring at Archax Capital, building. Some of their customers are BlackRock. They're building in the real-world asset tokenization space. We cover everything about RWAs, regulation, how these companies and tradfi are intersecting with the DeFi, and what are some of the things that they have to consider, including consumer protection. We even talk a little bit about Coinbase's 24/7 announcement that they're opening up the markets for Bitcoin and ETH derivatives and futures. This is a great conversation. If you are a business, if you are payments, if you are an entrepreneur in this space, this is probably the podcast you should listen to about RWAs and tokenization of everything. Let me know how you think about the podcast in the comments. Talk soon. This is your host, Stephen Sargeant, the Around the Coin podcast. We are in for a treat today. We have Angus and Keith O'Callaghan. No relation, but Angus, you're the head of markets at XDC Network. And Keith, you are at Archax, which is like a capital markets place that's housing some of the new evolution of tokenization and marketplaces. So Angus, why don't we do a quick introduction of you, Keith, figure out how you guys partnered other than your last names, and then we're going to jump into a little bit of your background.
Absolutely. Thank you for having me, Stephen. So I am one of those guys that spent 15 years in traditional finance and then made the break across to digital assets / crypto as a profession in 2018. Yeah. So crypto to me was 2015 when I first bought my first Bitcoin. Obviously one of those people that wish they bought more at the time, but that's where we are. Since then, I've worked with some of the largest asset managers, banks, advising them on crypto asset strategy. And most recently, I have the pleasure of being head of trading and markets at XDC Network.
I'm curious, before we get into Keith's background, Angus, you spent some time at Deutsche Bank, I believe, in 2016 and transitioned to their digital asset division in 2019. That seems pretty early for a bank to even be opening up a digital asset. This is after maybe the 2017 wave, but after that 2018-19 crash that we had, what was Deutsche Bank doing into digital assets at that time? Was it more supply chain focused? Was it more maybe settling from customer to customer? What were they touching on in digital assets back at that time?
Yeah, absolutely. It was very early days. And I can assure you there was two of us in the bank globally who are actually looking at digital assets. So it was very early on. And I know some of the banks on the street were looking at it closer than us, but it was investment in the future as much as anything. So I very much had a corporate development role. So investing in platforms and protocols and people using blockchain technology. And what we were looking for is to enhance our user experience. And as you say, supply chain finance or trade finance, Deutsche Bank being one of the biggest trade finance banks in the world, definitely in Europe. So that was the focus from them. So we were working on a lot of the initiatives. A lot of them were built on R3's Corda at the time, because that seemed to be the institutional platform in 2018. So yeah, we were just looking at how we can improve our processes. But I mean, that was 7 years ago, and how the market has changed over that period.
I love it. Keith, talk to me. You had a very similar path working in finance. When did you kind of touch into crypto or get antiquated with the crypto landscape?
Yes. So I've always been in the tradfi side of things. So worked at Morgan Stanley and then onwards, and then shifting over to hedge fund clients. So I moved from like sell side to buy side, and then kind of starting up hedge funds, running hedge funds. And the last hedge fund I was operating for, an American family office, they had kind of looked during 2018 at crypto, and they were intellectually interested by it. But at the time, like I was running a SEC RIA and a UK FCA manager. So we were hypersensitive to anything that would impact regulation. So, and obviously the IRS, how the IRS was going to deal with crypto was completely unknown as well. So we took the view that we wouldn't buy and hold directly crypto, but I would go out and find essentially hedge funds that would find strategies for us. And at the time, we're used to hedge funds being the Ferraris of the financial market. And what we saw, or what I saw, I just couldn't find any place I could allocate cash to. And then simultaneously, the guys who founded Archax, we worked together in hedge funds. They came along and talked about the regulated tokenization, things like that. So moving beyond crypto, but actually looking at the kind of the ultimate blockchain implementation. And that was super interesting. So the family office agreed for them to be housed in our hedge fund business. And then they grew asymmetric growth from that point onwards. And then I actually then decided to move over into Archax, which just, I loved hedge funds. It was a great business, but it did ossify, I think, for the last 10 years of my career in hedge funds. Everybody was kind of doing the same thing. There was no innovation. And then I walked into this Alice in Wonderland environment where, from a tradfi perspective, you're trying to get a grip. You're running just to stand still. So it's been super fun these last few years.
I'm curious, both of you have worked in TradFi, you've had the hint of crypto, maybe never going all in with the organizations you're working with. How do you balance catching something that your customers are demanding versus hey, this is a trend or a fad, which people have said about Bitcoin for the last 15 years as well. But when you look at something like the metaverse and you're seeing companies go all in on the metaverse or meme coins or Solana, how do you balance this is innovation versus hey, this has longevity or scale? I'm curious of how you look at that before you went all in on RWAs.
Angus, do you want to run with this first?
Yeah, absolutely. So I think it's been what drives any business. It's client demand, and any successful business builds what their clients demand. That's one of the things that I saw when I was at Deutsche Bank, and it's going to be very clear, I think, over the next year, is the custody of digital assets, whether that's in prime brokerage, going back to Keith's point around hedge funds. There are a lot of hedge funds that are now trading crypto, and they want to custody their bonds and their equities and their cash and their crypto all in one place. So I think the change in the US regulation, the clarification from the OCC now enabling US banks to custody crypto, I think there's going to be an explosion there from a US regulated bank perspective.
I love it.
Yeah, if I can maybe chime in from the Archax perspective. So in our minds, we bifurcate the two, crypto versus blockchain. They're obviously symbiotic, but in essence, one is a very nice way to essentially securitize every asset under the sun. And I've done securitizations in my career. It's been around for 40, 50 years and in terms of its evolution, but it kind of stopped about 20 years ago. What tokenization does is essentially supercharge securitization of any asset and gives it kind of superpowers. In essence, that's what it does. On the other side, and in crypto, we're both a TradFi business and a crypto business. The TradFi would encapsulate tokenization and financial assets. And then on the crypto side, we're not blind to that's where a lot of the money is in terms of transactions. And so we run an OTC desk, we do an exchange, we do DeFi, we do all these things for our clients. But ultimately, when we started out, this was about regulated tokenization. And so it's been a good business in the sense we've got two bites of the cherry, one on the crypto side and one on the regulated tokenization side.
Talk to me about this real world asset tokenization landscape. It was a buzzword maybe 2 years ago. Everyone was talking about RDAs and tokenize every building around the world, the Trump Tower and the Eiffel Tower. Everyone's going to tokenize everything. And even before that, I remember security token offerings was an acronym at one point too. Give me the lay of the land of where we actually are outside of the hype and the headlines of real world asset tokenization. And maybe what are some of the benefits that we're seeing right now currently, not what the future might hold?
Absolutely. So I've been in RWA tokenization since 2019. It's actually when I moved from Deutsche Bank. I moved to work for a company called Imar, which is the largest property developer in the world, printing around $6 to $10 billion worth of fresh real estate every year. So I looked at tokenizing actual bricks and mortar, whether that was hospitality units, residential units, commercial units that we owned. And we had a large portfolio to choose from. 2019, the regulation was very unclear and it was very difficult. It was an uphill battle. But I think fast forward to 2025, where we are now, if we look at what's actually the real world assets that are being tokenized, it's money market funds, it's financial products. And I think the tokenization of financial products rather than bricks and mortar, I think is much more achievable and low hanging fruit compared to when you have it's much easier to replicate on chain what's happening in the traditional finance world when you look at a money market fund, for example. Whereas if you have bricks and mortar, you have all the legal that goes behind that, the valuations. It's very, very difficult, but it doesn't mean that the mortgages on the back of that residential or that commercial real estate or the mezzanine debt that's associated with it, why that can't be tokenized. I think that's much more likely to happen in the short term than the actual tokenization of the bricks and mortar itself.
I just wanted to add there, your organization created a layer one blockchain. Is there a reason why you built your own blockchain versus maybe building on top of Ethereum or Solana or another blockchain? What was the benefits? We all know, have many founders that come on here. It's extremely difficult to build your own blockchain and maintain it and attract top talent, developers and builders of apps. What was the reason for building your own blockchain?
Yeah, absolutely. So XDC is actually a bit of an OG chain. So the Genesis block was actually 2018. So we're almost as old as Ethereum. So the concept of layer 2 blockchain didn't even exist back then. So, I mean, if we compare ourselves, because we're almost a similar age to Ethereum and myself, almost a similar age to them in terms of my time in crypto and digital assets, our consensus mechanism is relatively unique. It's delegated proof of stake, which effectively means that all of our nodes are KYC'd. So we know exactly who's signing those transactions. Whereas on Ethereum, you don't know who's on the other end, or you potentially do not know who's on the other end. And that means that, and also we have the flexibility because to build what we want, because it's our own layer one, whilst it is EVM compatible, but we can change what we like with it. I think one of the key aspects of that is it's a hybrid blockchain. So Ethereum being fully public, there are some private blockchains, layer 2s that are built on top of it. We have both within ours. So we have the open source layer 1 blockchain, which is the XDC network. And then we have subnets underneath that. So effectively, you have the self-sovereignty of your own data, but utilizing the XDC network technology. So very important for supply chain management and trade finance, because you may want to interact with the customer and not let the wider world know what side deals you're doing and how much flow is going through. So so we're best of both worlds.
That's what I was gonna say. That was the terminology and key. So Archax Capital and XDC Network combined, and they partnered to drive innovation and growth, especially when it comes to real world asset tokenization. But Archax already had, as you mentioned before, you already had a suite of services and solutions, including things like a crypto change, stablecoin issuance. What was the benefit to you, and that you believe that this partnership will help you solidify going into 2025?
Yeah, I think it from our perspective, let's say in terms of protocols, we're kind of protocol agnostic. There's a lot of great protocols out there. I do find, from my perspective, certain protocols, no matter how good their technology is, sometimes they don't have the vision, or they don't have the drive or the cohesiveness that's needed. And not singling out particularly XDC, but XDC is an example of one of those protocols where the founders and the team, they have a clear vision and they can articulate it and they can communicate it. So if from an Archax perspective, if we have an opportunity set, we'll give sight to someone like XDC on that, and then they'll be on the phone the next minute, and then we can actually start kind of working through how this might work, the opportunity, the potential benefits for the XDC community, and that. So I'd hold back kind of advocating any particular blockchain, because in essence we will mint to we have a tokenization engine that has XDC and several other, Solana, Arbitrum, etc. on that, and it's about the engagement between us and the protocol, and then essentially the messaging and that human interaction. It's people don't necessarily view it as important anymore, but for us it's that friendship and that us explaining where we are and the protocol explaining where they are and how we can benefit each other. So that's that. I would say that drove the partnership per se. And then one of the XDC group we knew for a long while as well, so that kind of helped us along in that journey. So overall, I would say we've done our first trade. We've done our first transaction with XDC, which is tokenizing some institutional money market funds, and that's really just to kind of get it done, and now we'll move to the next phase.
Angus, do you feel it's easier because you have this hybrid blockchain? Do you feel it's easier to communicate with the tradfi? Because their concern is always about too much transparency with some of the value transactions that they're completing. And they're a little bit scared of like full decentralization, which they've been sold on for years. Do you feel like having this hybrid approach gives an opportunity for whether it's Archax Capital or others to come into a space, build in the private nature, and expose what they need into the public chain as they grow or scale throughout your organization?
Yeah, absolutely. We are very proud to be partnered with Archax. One of the key drivers, they've got a fantastic team, super knowledgeable, super smart and experienced. And yeah, just been a pleasure to work with. And one of the main driving reasons for working with Archax is their regulatory status. As Keith alluded to, they have all the licenses that are required to enable us to do business with institutional and professional clients in the UK and Europe. And that's very important to us because I think regulation is it's not just coming, it's going to be the future, and it will be the regulated players that win out in this. So the ones that have maybe not abided by the regulations so far may have got a little bit of a head start, but as the regulations do bite in and clarification comes in, I think that's going to be the main area of growth. And as Keith said, we're very proud to have the tokenized money market funds from Archax on the XDC network. So that includes BlackRock, Fidelity, State Street, and Aberdeen. All money market funds are live on the XDC network through our partnership with Archax.
The partnership highlighted like this total addressable market TAM of like $30 trillion is what the tokenized real world asset industry is supposed to get to within less than 10 years. Do you think a lot of this demand is being driven by the success of the Bitcoin spot ETF in the US and the overall optimism this Trump administration has around stablecoin legislation, the custodianship of digital assets? What do you think is driving this $30 trillion number, and what's the biggest benefit to your clients, Keith and Angus?
Yeah, I'll take a run at this. I think like if maybe just park the ETF question. I think the ETF question, our ETF development and the ETP development in Europe is very important because it essentially normalizes an asset. Crypto is an asset. It will eventually be incorporated in as a security in the UK, probably in the US. Like the US has the CFTC, SEC bifurcation in terms of how they're going to manage that exposure. So what it did is it kind of normalized it, and also brought the names. It brought traditional names. I don't think it particularly helped, I would say, crypto firms. What it did is help to normalize the story and allow compliance officers and lawyers and all of these guys to get comfortable at the institutional level that, okay, this is something that we can look at. And that's kind of reflected in a lot of the partnerships we've signed with like BlackRock, Fidelity, Aberdeen, State Street, like a broad, like all the names in the street that you really want to be involved with. They're interacting with us, and we're sizable, I would say, in the crypto blockchain world as a firm, but we're a minnow compared to actually tradfi firms. Hopefully that will change in time. So the fact that we get this interaction and involvement at a very high level at all these institutions tells you the effect that the BlackRock and the various ETFs in the US have had, but also now we're moving to a much more kind of, I would say, sustainable legislative framework and regulatory framework. And all of that is just enhancing people getting more and more comfortable with utilizing, we'll say, this technology for real world assets.
Angus, have you seen the uptick in people thinking like, hey, like we see this trend, we see the momentum, but we don't know where to start. We don't know what, should we be building our own blockchain? Like internally through some of these big organizations, should we be utilizing a layer one like yours? Like, tell me a little bit about the demand you've seen over the last, I would just say even like 3 months, maybe 12 months.
Yeah, absolutely. I mean, if we go back, say, we're going to go back 48 months. When I pick up the phone to an asset manager, they probably didn't even have a digital asset team. A few of the banks might have a coalition of the willing, a small group of people scattered across the globe that are trying their best to get some sort of digital asset strategy. But now every bank I speak to has a very sizable, fully focused digital asset team with some very senior people on it. And I speak to the asset managers a lot, including the ones that have tokenized money market funds on XDC. And the level of seniority of people that are involved and are focused on digital asset now, I just didn't think it would happen this quickly. So there's a lot of people being repositioned out of certain roles into very senior roles in digital assets because they see this as the future. So that's across the largest asset managers in the world and largest banks in the world.
Maybe I'll just jump in there just to kind of picking up some threads in relation to this public versus private. So this is, I would say, the untapped question. People are going along and not really addressing it because I know regulators. I've worked as a regulated person in hedge funds and investment banking for 30 years or so. So I know somewhat how regulators think. And it's important for a regulator to obviously be able to understand the risks in terms of exposure of issues for consumers and the like. But also there is an element of who do I point the finger at if it goes wrong? If there's a security settlement issue en masse in the US, you go to like the DTCC and you kind of say, okay, you're at fault, you're the person. And there's someone, essentially the vase catcher that's there. The difficulty for a regulator, and it still probably hasn't been addressed yet, is that for public chains, if it goes wrong, who do we blame? Who's responsible? There's issues around if a transaction was validated in the US, but it was two persons in Europe, does US law or commercial law override? Just all of these kind of outstanding issues that they're quite nuanced, but they're actually quite powerful overall. So like I would say, just anecdotally, I would say that like from Archax perspective, we always use, for our own business, we always use private on public, but we do deal with private chains on behalf of the customers. But I can say that there's probably a transition towards the private on public as people get a bit more comfortable, but it won't happen en masse until regulators kind of come up with a defined position of, okay, we are comfortable with a public chain and subject to these particular requirements. So, yep.
Can you talk to me about regulation? You're regulated, I believe, obviously in the UK. You might hold licenses in the EU, but we see that the markets and crypto asset regulation, MiCA, coming out of the EU, is probably the most comprehensive regulation we've seen with digital assets. Many saying maybe too comprehensive. What are your thoughts about the regulations in the UK versus maybe the rest of the EU? And then how do you navigate that EU market? Is that more benefit to you? You get one license in a European Union country and you can take it amongst the other member states. Is that more beneficial than following the travel rule and all these other onerous regulatory requirements?
So I will just make a general comment about regulation, and I'll bring it back to, let's say, when I was running in a fund manager. So it was very clear because of the concepts of, let's say, regulatory equivalency. So if I want to do something in Hong Kong or in the US or in Europe, etc., I kind of knew what the direction of travel was, because there was, over the years, there was a mutual understanding between regulators that if you're a good regulator and I'm a good regulator, so if you and therefore you regulate your guys well and I regulate my guys well, so therefore we're going to have this concept of equivalency where we will lower the bar in terms of letting your guy into to access our market. That doesn't exist in crypto. So there is a complete siloation, the silos of regulation happening everywhere: the US, UK, Europe, Hong Kong, Singapore, elsewhere. Other places are quite slow and they're catching up now. So if you're looking to do a global crypto business, you've got to really stash away a lot of cash just to invest in that compliance journey. It's sometimes insane because it's constantly moving. But going directly to your question, like we mainly operate out of the UK and the EU. We have just like we've got a kind of a small license in Dubai, and we'll probably make a move in the US in the next, hopefully, few weeks. So like obviously we're very interested now in the US. We think we think it may start drawing up all capital and all talent, sucking it in away from Europe and the UK. So we need to be prepared for that as a business. But so I would say about MiCA. MiCA is as you say, it's a very comprehensive bit of legislation. The rule of thumb generally is that it's better to have legislation than not to have legislation, because if you follow the legislation, no matter how onerous it is, you can't be essentially attacked for making decisions and then someone applying 20/20 hindsight to what you've done. In the UK, we have a kind of an amalgamation of various little rules that they put in, but it's in no way like what's happening in Europe. So I would say in Europe, it's a good thing that they've done this, but what happens since really is ESMA and the regulator kind of tightening up things and changing things. So it's actually making it quite difficult, I would say, to have a commercial business in Europe at the moment. And I think like in time, it will start regularizing itself. So we had big legislation like MiFID and AIFMD in Europe, even GDPR in Europe. It tends to migrate outwards and it tends to normalize behaviors. So I think Mika's got a lot of, we need Mika too, basically, to kind of, okay, we've got this out. It's been a good thing that we've done, but now we need to, because Europe will fall behind. It's 100% that Europe will fall behind on the basis of the kind of the strenuous economic requirements to run a business in Europe. But the thing is that Europe has done something that the UK hasn't done, which is put their cards on the table and says, this is how we're going to do it. So it's a very good start. And I think looking back, kind of maybe that was kind of how we experienced AIF&D, which was the big investment management directive. And it took us a while. We were all complaining, and then we just normalized it, and then it got on. So I think I'm quite hopeful for Europe on that basis. The UK is been much slower. So we've got a set of regulations that people can sell to retail certain crypto assets, but there is a kind of a regulatory moat around the UK. But it's definite that the political uncertainty and upheaval in the UK has kind of delayed everything. The regulators was looking for direction. It wasn't getting, I don't think, the direction it needed. Now it's slowly starting to happen. But realistically, I think it'll be 2026 before we start seeing sizable moves in UK regulation. You know, we are expecting something on stablecoins quite soon, which again is good to have. It'll regularize it. It doesn't look like the best legislation in the world, but at least it's legislation. And that's for anyone running a business, you want certainty. You need certainty.
Yeah, and it's what's really put the US back in terms of there was no clarity, and then regulation by enforcement, many would say. Angus, I'm curious your thoughts. You're here balancing this decentralized nature of a blockchain, but you also realize a lot of these tradfi companies coming into your space, they also want compliance. They have tax and accounting principles and reporting that they have to do. How do you balance this kind of Web3 and I feel like intersection used to that with NDX?
Yeah, absolutely. So, I mean, I think just to follow up on Keith's point there, I mean, I was heavily involved in MiFID II when I was at Deutsche Bank on the equity trading floor, which went live in 2018. And that regulation reverberated globally. So whilst it was a European regulation, it impacted the US and Asia, not to the same extent, but especially from an equity trading perspective, that impact was there. I think MiCA will have a similar impact, and MiCA 2, as Keith alluded to, is required, and GDPR as well. Because we've got to realize that today's world is very global, especially these traditional finance entities. They operate on a global basis, and they like to have as much as possible, a level playing field, so they don't have to, so they can operate in a homogenous way as much as possible, because maintaining the legal and compliance and for each jurisdiction is very difficult.
I'm curious, Angus, we see, like you talked about global, the Bybit hack has shocked the crypto universe over the last couple of weeks. Companies, crypto exchanges are scrambling to make sure that those tainted or stolen funds aren't laundered on their own platforms. But I'm sure there's a lot more interest from your investors, customers, and partners on how safe your technology, your platforms are. What has been maybe the biggest concerns, or would you notifying companies that they don't have to worry about because maybe cybersecurity is at the top priority for your organization?
Yeah, I mean, cybersecurity and the resilience of the network is absolutely key to us. So we are smart contracts. The protocol itself has been verified by the top names in the game, and the reports are there to show the resilience of the platform itself. And that's why we try to engage with regulated entities as much as possible, because whilst we are a platform, it is our partners who are building on the platform that the regulation really does hit with. And we do our best in the design of the platform to make their lives as easy as possible. I hark back to our delegated proof of stake mechanism, where all of our nodes are KYC'd. That's unique. And for regulated entities, knowing that a KYC entity is there. And when we say KYC entities, I'm talking SBI Holdings in Japan, Deutsche Telekom, GSR, some of the biggest names in TradFi and Web3. Some of the biggest market makers in the world are running nodes on the XDC network. So these are trusted, regulated entities. And that's very key to us and gives reassurance to people that are operating and building on XDC that it's a robust system and that they're in a safe environment.
Keith, I'm curious, you mentioned a lot of organizations, BlackRock and others. Do you get does your Slack channel start going off with hey, what's going on here? Or are we at the maturity of crypto that these things do exist? They will happen from time to time. But I think the large scale nature of this attack and the sophistication has to probably bring some of your partners, investors, and clients into question. What are some of their risks, especially because they're coming to you and you're going to other platforms to offer these offerings?
Yeah. So I would say, again, there's two types of assets. There's crypto, which is a bearer instrument by its nature. And then you've got real world assets, which is generally a non-bearer instrument. So in terms of the real world asset side of things, I'm not saying that you shouldn't be worried about a hack, but ultimately those real world assets exist somewhere. And the way we structure it and the way investors now are looking to have these structured is to have a regulated custodian or a regulated trustee holding the assets. So immobilizing the assets in essence and servicing those assets and then our process is to immobilize and then to tokenize those underlying assets and they go out. But especially in terms of financial products, you're required to have client categorization, know your customer. So there's a certain kind of, let's say, permissioning that's done at the stablecoin at the smart contract level, and it's like whitelisting addresses, things like that. So for real world assets, you're not going to ever really be subject to that mass robbery of assets. Like in essence, because we hold the assets and we hold private key for a smart contract, and we're the tokenizer, or if we can work with other tokenizers, but ultimately we can burn and resend those tokens as they are in terms of real world assets. The bulk of real world assets, especially in the financial market, are non-bearer. There's certain instruments like stablecoins and the like that are bearer by so we run a number of stablecoins for clients as well. So we structure them, we run the mint burn operation, we do the tokenization. In that instance, there's probably a bit more scope. So if someone wallet gets hacked, it hasn't happened before, but how do we interact with that? Well, it's really up to the issuer to decide what they want to do. But in terms of the crypto side of our business, yes, that is subject like every other crypto firm to hacking. So I would say we've got two things going for us. We use Ripple custody and we use Fireblocks. So two of the kind of leading custodial systems. And then I would say just because we're a tradfi firm, cyber has been a big issue in every, the SEC, the FCA, every regulator has been pushing this for 20 years. Before you get a regulated firm out the door, you need to have done a lot of work in terms of mapping out your vulnerabilities. So I would say those two things have protected us. But in the end, like, you have to run the best business you can. You can never say never to these things, but definitely in real world assets, because of their nature, they're non-bearer, so they're therefore controllable. So someone can steal them, and then we can just burn them if they steal them.
Right, like similar to Tether, they have control over somewhat if they want to freeze certain assets that are being used in their stablecoin. You would have a similar power, I'm assuming?
Yeah, well, it's really up to the stablecoin issuer themselves. I think most stablecoin issuers really don't want to say, well, I think they're very comfortable to say that, look, we can lock the wallet, but I don't think they're ever comfortable to say that we can burn in wallet, because that goes against the whole ethos of what crypto is about. But ultimately, I would say all regulated stablecoins will have a sanctions list built into them, and that'll either be maintained by smart contract or by an smart contract or by an oracle. So that'll just ensure that the terrorist organizations and the like can't access it. Whether let's say, for example, a tax fraud or something like that can be addressed, it's a very legal question, because now we're talking about extraterritorial things that were really at government level. When you bring them down now to like a stablecoin level, very interesting questions, no particular answers, but in the end, we'll deal with it if it happens. And issuers and stablecoin issuers will have to deal with these things.
Do you either of you think that, the whole consumer protection angle, especially with what happened at Bybit, FTX, Celsius, and other places, do you think it's the consumer protection thing that's slowing down these regulations for coming into formation? Or do you feel like the regulators just aren't educated enough to create regulations on a technology that they're not so well versed in, because most of the talent is in the private sector? I'm curious about either of your thoughts on this.
I mean, from my perspective, I think they've just been caught asleep at the wheel as much as anything. You can go on any retail trading platform and you can trade CFDs at 20, 50x leverage and commodities. And a lot of commodities are more volatile than crypto assets themselves. So people refer to it as gambling, but I'm very much, people should have the choice as long as they have the means in order to do it. But crypto is seen as a casino, but that level of meme coins being the latest phase from the casino world, but that's been available to retail traders for years. So CFD and spread betting on the likes of IG or whoever. Yeah, that's always been available. It's just the fact that it's crypto that, just the regulation needs to catch up.
You can't even watch a football game without seeing like what bet you can make on how many field goals, halftime score. It seems like betting in fantasy sports has now become a lot more regular. When I started in crypto, I felt like the IRS was looking if somebody sent crypto to a gambling service provider. That has completely gone away with like the president launching their own meme coins. Before we go to Keith, Angus, I'm actually curious because you have a blockchain. I'm always asking blockchain founders and builders, how do you attract top talent to build on your blockchain? Because it seems like giving away tokens or grants only lasts for so long. And that might attract a lot of people, but a lot of developers are just bouncing from blockchain to blockchain, trying to collect as much tokens as possible. So how do you attract and maintain top talent at XDC?
Yeah, absolutely. So we have an in-house incubation lab, and we have a VC arm with an assets under management of about $150 million. And yes, we do have a grant program ourselves, but we're working with some of the best incubators on the streets, whether that's Launchpool or Tenity. So we've got about 5 or 6 external incubators, which we do provide not just financial assistance, but technical assistance in order to build on XDC. And as you say, if it works, it's about, if you've got the right platform and people build on it and it works, they will stay around. The gas fees on XDC are almost de minimis. If you got an old school calculator, you'd struggle to get in the gas fee on your transaction because there's not enough zeros, right? It's almost gasless. So if you, and 2,000 transactions per second in excess of that with 6-second finality, the technology is there. And once you've built on a chain, there has to be a good incentive to move off of that chain. And it's not just for an additional grant, because there's a lot of protocols that do have large treasuries and they can throw grants around. But if you can get people building on the network and it's got a great community and it's got great engagement, once people are built, they will stay because there is no incentive to move, because it's not going to be cheaper. It's not going to be faster.
Keith, I want to go to you. You know, Archax, when you're dealing with financial products, speed, finality has to be important. How huge is transactions per second in your line of work? Do you have that many transactions, or is it the speed of the nature or the finality of the transaction that's more important to some of your customers?
I would say at this moment in time, I would say the speed of transaction isn't very, very important for RWAs. It's like, as you say, finality, stability, a blockchain that has implemented some sort of KYC, AML framework in the way it's set up. So it's those kind of aspects but in time, yes, the transaction rate, because like there's some projects that we've got in the pipe in relation to digital bonds in terms of, and then also tokenized financial assets like treasuries, and that if we're successful in that'll be essentially shifting that market into a much more fluid environment where price discovery and price liquidity should increase, and therefore attributes like gas fees and TPS are become very important at that point.
I'm curious, when you're talking to some of these clients and they talk about settlement, like the traditional settlements, and correct me if I'm wrong, 2 to 3 days to settle something simple like a bond versus like 6 or 7 seconds. How much is there a huge cost savings, like based on different types of infrastructure that you're working with? Like people say like, oh, like the days, like you can settle so much quicker. What's the financial benefit of settling quicker? Is there one, or are you removing so many different financial intermediaries from the process? That's where the real savings come in.
Yeah, I can say from our perspective, it is, you've seen both settlement cycles in the US and in Europe start to compress. And the reason it's compressing is because of capital utilization and risk. Post Lehman's, did I really want transactions that were settling in like T plus whatever, where I could literally take risk off the table within a second? So I think even on the tradfi markets, they're moving that way anyway. There's plans to implement T1 and the like. And on another side of our business was that we've created a central securities depository, kind of like DTCC, like Euroclear. We're doing that because we feel that that market for digital securities, that structuring that exists in the tradfi market, that doesn't exist in this market, And for us to be able to convince the big players to come in and settle their trades, but have the look and feel of what they're used to, but except in a digital structure is going to be critical. But again, the cost saving is dramatic. Like I ran hedge funds for 20 years. The pain of was it trades that weren't matching, like you've got like several people in this pipe, everybody trying to agree on silly things like a dollar off in terms of like a 20 million trade, a dollar off, and you get the stupidity. So whereas the solutions that Angus and XDC and
yeah, I'll jump in. Well, Keith comes back to us. And yeah, I 100% agree with Keith. The velocity of capital is absolutely key. And the reduction in risk and reduction in costs is absolutely, it's monumental. So whether that's counterparty risk, as Keith said, only have to look back to 2018, Lehman Brothers exposure, things like that wouldn't exist if the trade was settled in 6 seconds, for example. So that's counterparty risk. And then obviously the reduction in cost is absolutely huge. And that's not just across equities and bonds. I mean, FX, there's mitigating factors for FX, CLS, for example, which is one solution which reduces counterparty risk, but not all currencies are on CLS. A lot of volume is still off. So yeah, I mean, I think it solves a lot of problems from a risk and cost perspective.
We've talked a lot about stablecoins in this conversation. Maybe just final thoughts on, like, Keith, where are we going with stablecoins? People are saying 2025 is the year of the stablecoin. You probably see it better than many people that come on this show. What's the demand? What's the use cases that you're seeing your customers are using it for? And then is there a need for stablecoins as much? If you're doing real world asset tokenization that can settle in seconds, the need for a stablecoin doesn't seem as much, considering that you can solve a lot of those problems with the RWAs. What are your thoughts on stablecoin?
Yeah, I would say, going back to one of your early points about the effect of, let's say, the Bitcoin ETF on crypto firms and the crypto industry, I think actually the stablecoins are the things that are moving everything forward. So I would say that the legacy stablecoins are being slowly but surely not outlawed, but strangled out of particular markets. The EU essentially is pushing out stablecoins that don't fall within its remit of understanding, and it's changing the landscape a lot. So I would say in terms of stablecoins, I remember when we started off this, like, we got approached, we did a position paper because like we did lots of structuring in our previous life, so we could structure these things quite easily. And I remember us discussing, is this a business we want to get into? And there was this discussion about CBDCs, and like CBDCs will obviously displace stablecoins. But actually, the more I've gotten into it, the more I believe now the stablecoins are here for the longer term, just because with CBDCs, governments are just slow. People don't trust governments. And even the construction of some CBDCs, they're extremely limited. You can have, let's say, 3,000 sterling in your CBDC. It doesn't pay interest. It's the maximum balance you can have. What's the point? And I would say the banking industry, in terms of that type of market, has done a great job. It does the job effectively. You don't necessarily need a CBDC, I believe, to help the banking market. However, stablecoin is completely different. Programmability, fluidity, all of these things, it's a great enabler, because every time we look at things like creating new products, stablecoin always is in the mix. If we're talking about rewards, if we're talking about staking, all of these things, stablecoin always comes into the dialogue. So I'm super bullish on stablecoins. The reality is that there's issuers coming out of every direction at the moment, and there's obviously a limit to how many US dollar stablecoins do we want. But that's just natural capitalism. It'll work itself out in terms of how good they are, in terms of the quality of the smart contract, how well they're supported, where they're listed, etc. I think that's a key point. But I think definitely I would say non-USD stablecoins is going to be a very interesting area. You've got people like, I would say, Zodia, who are doing a good job in terms of addressing the emerging market side of things. So I think there'll be a big push, Archax included, who will be looking at different currencies and potentially creating baskets of currencies, kind of like index currencies, commodity-like currencies. Because ultimately, if I create a US dollar stablecoin, I can create any type of currency on that basis. So I think the growth is there. I do see two, from our client base, I see two separate cases where stablecoins are utilized. One in a public way, so the kind of the Tether USDC way, and then in a private way where it's a large conglomerate that's doing something, and stablecoins suddenly frees up a huge amount of cost, quickness, and allows the whole community within that private network to actually interact with each other, lend each other money through staking contracts, things like that. It just creates amazing versatility. So I'm a big proponent of stablecoins. I think they're here for a while yet, and they've given life. I think without them, the crypto environment that we exist in now probably wouldn't exist in the way it does.
It's definitely been the killer app that we've all been talking about. Angus, I'm curious from your side, what are you seeing, whether it's stable coins or other applications building on your platform, or just anything else you're seeing in the industry that the viewers and listeners should be thinking about for 2025?
Yeah, absolutely. So USDC actually is now on the XDC network. So they were using the USDC bridge. So that was just announced last week. So we have other stablecoins that are on the network, but USDC obviously being the second biggest in the world. I mean, from my outlook on stablecoins is, yep, USDC, USDT are obviously head and shoulders above the rest. But I think there's a lot of margin there, and the structure of stablecoins going forward is going to change. Because if we look at Tether as an example, right, they make almost twice as much profit in a quarter than BlackRock, which is an $11 trillion asset manager, right? So just to put that into perspective, the size of Tether at $150 billion or something like that is able to make more profit just by collecting the yield on the US treasuries that they've invested in. So I think we'll classify it, some people seem to refer to it as stablecoin 2.0 is the yield-bearing stablecoin. So the SEC has just approved the first one, and I think many more will follow suit, because why would you hold on to, even though Tether, it's a bit like dollars in the FX market, most trading is actually done against Tether. I think if a yield-bearing stablecoin takes hold, which I think it will in due course, especially with interest rates where they are, it's a sizable amount, people will park their funds in a yield-bearing stablecoin or a money market fund, perhaps, where if it's easy enough to get in and out of those positions at minimal cost, because 5% a decent amount of money if you're sitting on enough of it.
Yeah, can I just jump in there a bit to kind of give some other color on this? First thing, I wouldn't say, like, if you push the SEC to say, have they approved the first US stablecoin? I'd say they would say, no, we've approved essentially face certificates. That's what it is. It's a kind of like Reg D type, or maybe a Reg A or Reg D type instrument, which is quite limited in terms of what it can do. But it's a good start, and I'm not knocking it, but it's not the killer. It's not the killer thing. I think it is coming down the line. I do think yield-bearing stablecoins are going to be very difficult to implement, because in the US and in all leading jurisdictions, it would possibly be viewed as a collective investment scheme, because you're essentially managing assets for profit for clients. And this is usually the kind of Howey test concept when you're looking at collective investment schemes. But one thing that we're doing actually that I think is quite interesting is that we're using money market funds, as we've got together a group of like leading global custodians, leading asset managers, banks, to come in towards a network where we're working to create money market fund tokens as essentially a settlement kind of firstly a collateralization network, but ultimately, the way I look at it is that if I can tokenize an asset that's constantly earning, and if I accept that it's $1 and you accept it's $1, and I'm earning interest up to the time that I transfer it to you, then in things like treasury management, are you worrying about putting that money in a savings account, disappears, because the second it hits your wallet, you're going to get airdropped that interest on an ongoing basis. So it kind of displaces fiat eventually, I think, if you create this kind of securitization within tokenization. And I will say something that always surprised me about the US's pushback against stablecoins is that it seemed to be, besides us having an interest in them not doing it, it is for the benefit of the US dollar and the US treasury markets, because if stablecoins really take off in substance, what you're doing is essentially locking in that market. Whereas before you had large pension funds holding these securities, now they're not so much, because people are retiring. They got to pay pensions. They're selling these treasuries. So governments around the world should be really focusing on stablecoins, saying, okay, this is going to, as pensioners come out and just spend their money, I'm going to get these guys who are going to essentially create stablecoins, which is essentially anchoring my debt markets and anchoring my currency to some extent. I saw, without me having to take out a gun and shoot someone, like it's soft power, perfect soft power. So I was always surprised why the Americans didn't really grab it by the neck and run with it years ago, because it's so much in their interest.
And especially with all the alternative now markets happening with BRICS and the digital yen, like there's a lot of markets that are happening outside of the traditional US oversight, and especially North Korea, Iran, Russia, China. So the government, that US dominance, definitely the stable coins and USD backed stable coins are definitely holding some of that dominance based on what you're saying. Guys, this is an amazing conversation. I always like to end the conversation to see, like, what are you, your tech friends, the crypto? You guys are working in a fast-paced world, many vices in the traditional and the crypto hedge fund space. What are you guys tinkering with, playing with on your own, or what are some of the heavy tech and dev people doing with on their weekends?
I can take a run at it first. So obviously AI is a huge thing. It's a huge thing now in hedge funds. I hadn't realized how huge, but hedge funds are pouring real money into this to develop their business. So obviously now we're doing the same thing. But I would say just kind of in terms of real interesting things that I'm seeing people do, I've two of my children doing computer science degrees. So they're in this space. But the big thing they're talking about now is vibe computing, which is essentially kind of creating a kind of a terminator where you and the AI work together and you let the AI do the programming, which is super interesting. So I think that's probably the most advanced thing I've heard now. And all the guys I know in computers and maths are super excited about this.
Super interesting. Angus?
Yeah, I hate to be boring, but unfortunately it's going to be AI as well. I mean, everyone is focused on it, whether it's creating pictures or, I mean, I'm not quite sure how we lived without AI previously, and it's not been around for that long. I mean, I'd say I use it on an hourly basis, and that's both personally and professionally. So yeah, all my friends are talking about it. What's the latest agent? What are you using now? And whether that's from Canva, Copilot, Grok, you name it. And XDC actually has its own AI agent, which helps people developing on the XDC network to write code. So you can talk to the AI agent and it will come back with suggested code to help you build your programs and build your protocols on the XDC network. So yeah, we are fully engaged in AI, both professionally and personally.
I give it about 2 years and there'll be just 3 robots talking here. Like,
I'm curious. I just typed it in there quickly. Like Coinbase is launching this 24/7 market when it comes to like ETH futures and BTC futures in the US. What are your thoughts on the outside looking in, especially a lot of you played in the finance space? Is this good for the industry, maybe bad for the industry, or what are your thoughts on this?
Yeah. Well, I can say from my own experience, like we traded the markets. Generally, we closed with the US markets, and our settlement guys were old school. They settle their trades, and that was that. So if I came along to them and said, we can do 24/7 trading, the question is, why would we want to do it? And we get that, but the reality is that we're offering it to clients. Like obviously Coinbase are doing their perps in Bermuda as well. So they've come from nowhere to really, they're really killing it on that business. It's super impressive what they did. But so like the reality is when you're given something that you don't necessarily see the use case of it immediately, suddenly it becomes absolutely embedded in your life. So if you go back to, was it Steve Jobs when he wanted to do the iPhone, it was really about collecting your music, not about apps, making a phone call and having your music on a small thing. It wasn't about what the explosion that happened afterwards. So in essence, we all started, like, I'm older than you guys. Like I remember the first mobile phone, and it was kind of like, why do you need it? Because like we just arranged to meet in town, but now I can't. Like I've kids everywhere. I've got to just make sure that everybody's still alive, and it's so it eventually, if you create the optionality eventually does get taken.
Angus, any thoughts from you? Closing thoughts?
Yeah, absolutely. I mean, it seems that the market is going to go that way for good or for bad. So I used to like it on the trading floor when the market's opened at 8 and shut at 4:30, because then you were risk off. You passed the buck to the States, and then that was it. So that follow the sun model will still exist, and it will have to exist in a 24/7 market. So that's going to be quite interesting. And Coinbase with the tokenized securities is going to be quite interesting, because I remember it goes back to FTX actually. So FTX, and actually this was pre the Coinbase IPO. They'd created a synthetic market for Coinbase. I think it was trading at about $620 at the time. And then it listed at 410. So yeah, you can see that dislocation, but obviously this time round it's been done properly, and it'll be exciting to see. But it seems that Coinbase are really pushing ahead with these initiatives now.
Gentlemen, this has been a great conversation. Congratulations on the partnership. And you can see with your two wise minds why it makes sense for Archax Capital and XDC to get together and build out the RWA ecosystem and give access to a lot of your partners to the facilitation of a lot of these assets. Thank you so much. Where can people find you, Angus, to get in touch with you?
Absolutely. So you can find me on Twitter, you can find me on LinkedIn, and it is xdc.org if you want to come have a look at the XDC network. And forward to welcoming you. And please don't feel free to reach out absolutely anytime.
And Keith, where can people get a hold of you and throw some money at Archax Capital to invest in all these RWAs?
So we're all over LinkedIn and Twitter, and we've got a good team that look after TG channels and WhatsApp channels and the like. So LinkedIn is probably the easiest place. It gives a lot of information, and obviously archax.com is the website.
Awesome. Thank you, gentlemen. And thank you for coming on Around the Coin. We'll probably have you maybe back at the start of next year to see what 1 year under the Trump administration and what's opened up in the RWA space. We might have to bring you on next week at the rate Trump's going. So it's great to have you guys on the podcast.
Brilliant. Okay, Stephen, thank you so much.
Thanks for having us, Stephen. Thank you.